Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Caterpillar stock. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comment section. I'll get the ticker on the whiteboard behind me there, and eventually I'll make a video. If it's a stock that's in the S&P 500, I post those on YouTube for free. The other requests I post on Patreon. And at that $5 a month tier level, you can just request any stock and I'll either give you some quick feedback on why I don't have much to say about it, or I'll make a little video analysis for you if it's a stock that's not in the S&P 500. And as long as it uses some of the strategies that I actually share on the YouTube channel, I'll share those as well. If not, and it's a strategy that's in the full Cyclical Investors Club service over on Seeking Alpha, that I kind of have exclusive there, I'll kind of share my thoughts on it, but I might not go deep into my actual strategy. And if you do join over on Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service. I'll have all those links down in the description. I will also have a 25% off affiliate link for FastGraphs, which you'll see me use here in this video. I use it in a lot of videos. I've used the service for 5 or 6 years now. And for the type of earnings growth analysis that I do, it's very valuable to be able to sift through stocks quite quickly and narrow things down to the ones that actually kind of fit the strategies that I'm trying to do. And then depending on the strategy, it can be very useful for the valuations as well. All right, as always, this is not individual investing advice. This is just how I analyze stocks. And Caterpillar is... Well, a little history here. I first developed, you saw this as a Cyclical Investors Club, right? So I focused on cyclicals when I first started doing this full-time in 2018. I'd been writing, I researched my cyclical strategy in 2015. I started using it myself and writing some articles about it in 2016. And then I had some success with it. And in 2018 is when I quit my job and started writing about cyclical investing full time. And Caterpillar holds a special place in my heart because it was the first article I wrote after I decided to make this my living. And I warned people basically about the cyclicality of their business. And I went and looked, and the article came out on January 15th, 2018. So I think the closest one is about right there. That ended up being a peak for Caterpillar stock for a couple years, and the price fell almost 50%, I think. Yeah, this isn't completely peak to trough, but I want to say it fell 40. In my notes, I had it as 46% roughly. Off its peak price after I warned people about it, about how far it could fall in a cyclical downturn, and then it did. And actually, I warned people about a bunch of industrial stocks in January and February of 2018, and they all fell deeply. So the industrials, cyclicals, the classic ones, I batted 100% for those couple months. Now, I did use this strategy for some more consumer-oriented, I guess, stocks based on historical price cyclicality. That was before I started using historical earnings cyclicality as my main focus, kind of some lessons that I learned from that. And so I did warn a few people about, and most of those consumer cyclical had issues too, but the one that didn't was Costco. I think I did really well as a basket, but Costco I warned people about, and it's gone on to get I don't know how many hundreds of percent of return. So I've never covered Costco since then. I just let it do its own thing. But I did learn that I needed to expand when you start doing something all the time, you just learn more along the way. So I made some adjustments, and when you see me do my earnings analysis, or when you see me look at the earnings history and base the initial cyclicality on that came from some of the early mistakes that I made. So my Caterpillar was a good warning, and unfortunately, I think my buy price for Caterpillar, which is still going to be Spoiler alert, minus 50% off the highs is what I'm looking at for a Caterpillar. It just barely missed that. Now, when I do these type of analysis, I'm not predicting exactly where a stock will go. That's not how I think about it. I say there's strong evidence historically that the stock price could fall this far off its highs. And if it does, that's when I'll be willing to come in and buy it, provided all these other factors, work out. So sometimes you don't get to buy them if they don't quite hit your buy price, and that's what happened with Caterpillar. But I did buy one other very similar, I think, but smaller cyclical business at that time, right at this bottom, and it went on to return like 150%. And the funny thing is, this is a small cap, so it's in the full Cyclical Investors Club service. So I'm not going to tell everybody what the name is, but the funny thing is I just bought it again. So it actually went down here, rose like so, and then fell back down, which is what usually happens. And we're seeing it with a lot of industrial stocks right now, industrial materials, but we are not seeing it with Caterpillar yet, not to the same degree. And I think Caterpillar and Deere in particular have kind of formed their own little group because they did really well coming out of the pandemic, and people know them, they're familiar. And I tell this story all the time, but they're in the S&P 500. People think their investors feel safe with them, and they've had a really good run. So there's a lot of happy investors, and so they just haven't fallen yet. We can take a look at Deere too. I mean, you see the peak coming off the peak here. I saw someone posted Deere was at a 52-week low, so maybe it might be at a 52-week low, but it hasn't really fallen, right? The stock price hasn't really fallen much, in my opinion. So Caterpillar and Deere are in similar situations, I think. So just to go back through the process here. So the way I would categorize Caterpillar as a cyclical business is to look at these earnings per share drawdown. So we have a 60% drawdown during the Great Recession. We also have a cumulative, let's see, it goes from 8 down to 3, so that's more like a 60-something percent decline off the earnings peak. This was the industrial, I call it the industrial recession, when fracking peaked basically around 20. We can kind of see it in Caterpillar's. It kind of peaked within these couple years here, 2012, 2013, depending on which business earnings you're looking at. So this industrial recession was actually very similar to the Great Recession in terms of the earnings declines. So we have two instances here, even though they had a year with a bump kind of in the middle where we have really deep earnings drawdowns. That would be enough to call it a deep cyclical business. Now, I distinguish between a deep cyclical business and a deep cyclical stock. Almost always deep cyclical businesses are also deep cyclical stocks, but occasionally, sometimes with insurance companies, people kind of can ignore a bad year. Every now and then you'll find one where the market just ignores the earnings declines, but usually if earnings are cyclical, then the price is cyclical as well. So similarly, what I want to see from a potential investment standpoint is that the stock price also falls at least 50% off its highs. Usually, the stock price falls more than the earnings with businesses like these because people tend to overreact. Might not happen quite as much with stocks like Caterpillar and Deere because people have confidence in them, but if it's a smaller, lesser known cyclical business, usually investors get a little more spooked. They get a little more moved by the price action of the stock. And so a stock might have earnings fall 50% and the stock follows 80%. Not uncommon. Those offer bigger opportunities usually, but I'm definitely willing to take the opportunities. So for example, the small cap I was talking about, or mid cap, it's probably mid cap, I was talking about earlier, I bought it when it was 65% off its highs. So the potential return there is more like 200% if it recovers, right? So with Caterpillar, I'm aiming for 50% off the highs. And you can see using the fast graph here, it fell. This is probably closer to like peak to trough, more like 80%. Maybe not. It went from 85 down to 21. So yeah, like 75% off its highs. Even though earnings fell 60, a little bit more than earnings, but not too much. But you can see the price definitely follows. If we go over to, I'm not sure exactly when this peak was. We'll go right here. 2011 down to this trough. That's about a 50% decline, okay? And then this was just the 2020 sell-off from 2018 to 2020 was a little under 50%, because I think if it actually hit 50%, I probably would have bought it. So we can see historically that you would have had one chance to buy during and this only, I have data that goes back farther than this that I actually look at when especially back in 2015, I didn't have these last two drawdowns. But so you can go back 30 or 40 years with Caterpillar and see that this pattern is pretty similar. So you could have invested during the Great Recession, you could have invested during the industrial recession, you would have just missed the 2020 decline. And then remember, this wasn't this 2023 or 2022 decline. This wasn't a recession, and it fell about 35% still. So you have to imagine if we did have a recession on top of that, probably would have fell 50% again. So the evidence is there, at least for me, that if you wait long enough, you'll probably get an opportunity to buy at 50% off its highs. And if you buy at 50% off its highs and you assume the stock will recover their old highs eventually, which this is a quality business. If you look at the earnings troughs, each one's higher. This is what you really want to see with a deep cyclical business. And then you want to see the peaks preferably higher as well. It's okay for me sometimes if it's kind of flat. That can kind of give me, but what you don't want is like a series of long declines usually. The only ones that are kind of tricky that way are the oil stocks, because they had this big super cycle like around 2008 and 2012. So it took them, you can look at them and most of them are going to be trending the wrong direction over the long run. But that was kind of a super cycle. So you have to kind of treat that one a little bit differently, I think. But most of the time, this is really what you want to see in a deep cyclical business. And if you can get them about 50%, and it doesn't have to be exactly 50. I try to use like clear entry points because I make videos and I write about this, and then I have people on my service, and when I put out an alert that says to buy something, it's easier for me to keep track of the results if I have like clear, prices and points that we're buying. But layering in, when it gets down to like 45%, down to 60%, and layering in around that time, perfectly fine. It would make sure you got a little bit in maybe in 2020 instead of missing it completely like I did. But there's no perfect system. So now back to today. So we have the COVID decline, we have the recovery, that's all good. And then because of all the stimulus money, in my opinion, we have this gigantic boost in earnings. We went from $10 a share to $20 a share, so a doubling in earnings. Usually see this type of thing, well, let's go look at 2008. This is what you usually see when peaks are forming, even though you never really know when the peak is going to be. So again, we have $2 a share, almost $3, doubling, going to 5 something, almost 6 a share. So again, in just a few years, really most of that happened in the first couple years and then just kind of hung out there. So you get this giant growth, and usually, eventually, you have a down year. And so we can kind of see this little spike right here, and we see earnings are expected. Let's zoom this in closer. Analysts are expecting flat earnings. There's 2 years of flat earnings before 2008. And again, it's not about the timing, it's just about the general pattern that happens. Now, in theory, you could have just a bunch of years with slow growth and you never get a real downturn. But that's just not the way I like to assume it's going to happen. Historically, earnings fall a lot during down cycles. Earnings growth does anyway. And usually the stock price follows. So for me, this is a pretty clear selling opportunity, profit taking. Almost everybody that didn't buy in the past 3 months is positive on this stock now. This would be one I would be reducing risk for sure. The interest rates have been raised and have been there for a little while. Usually it takes a while for that to enter the economy. It's taken even longer because of just locked in financing and stuff that people have, especially for housing. So, but eventually the economy will slow. Caterpillar's business will slow. Earnings will probably go negative. Often the market predicts this ahead of time with cyclicals. I'm going to go see what they actually did before 2008 because I wasn't paying any attention. So let's go back so let's see how the market treated it. So we had from 2006 this initial kind of warning shot here. This is much more clear if you go back to 1998, which I don't have I can't go back that far on fast graphs anymore. But you have this 30% decline right here. So that's the initial peak, really. And then we kind of had like a false recovery because, hey, things aren't so bad. Things are under control. And then we have another. So I like to call this the death wobble sometimes that happens before the big, drop off. And it varies. I mean, there's no guarantee that any of this is going to happen. But by the time you got here, and interest rates had been raised for a while because the Fed raised interest rates here because the housing market was just going nuts, and had time to kind of work themselves through the economy, and people couldn't pay their mortgages anymore, and then jobs got lost, and then that cascaded into more and more, which is this wasn't a typical credit cycle downturn, but it was. The dynamics were. The degree of it wasn't. So that usually happens before, and you actually see that this dip. I'm pretty sure Caterpillar is the one that I think Cummins too is a good one to look at. In 1998, there was like a drawdown, and then some of those cyclicals, like I know Cummins for sure, recovered by like 2000, and then got creamed. So you see kind of these signs ahead of time. This little dip down probably I think is going to turn out being one of those. So yeah, I would consider taking profits in this one. Now when to buy, I already said 50% off the high, but we can look at the we have a high of maybe 325 is not high. 382.10 is my high. Yeah, if you go back to 2021 drawdown, which was not on the fast graph, that was about a 50% drawdown for Caterpillar. 2008, it was actually, we saw was deeper than this. These are just kind of estimates that I eyeballed when I was going through. And then 2020 didn't get to my 50% level that I was looking at. So, but 50% is where I would be willing to come in and buy, even off this super cycle. I mean, it kind of balances out with Caterpillar's quality. So we need to come down the 41% down to $191.05. That's when I would be willing to come in with a 1 or 2% weighted position. 1% is kind of my standard. And chances are, if Caterpillar's down here, maybe I could pick up Deere, maybe I could pick up some other industrials that are even cheaper. I've already started buying 1 or 2 of them. The small cap one that I talked about, and then also like Albemarle is one that I made video on. It's more of a chemical, right, lithium, but we can see they had this big super cycle, and I bought at I think 117 was my buy price there. It's down 70%. I'm pretty sure I said that it could get down in the 60s. I'm not sure when it was down. Yeah, all the way down to 50 here. So this is one where I took my initial position, and then you just have to kind of wait and see how bad this down cycle is going to be. Right now it's looking pretty nasty. So if it got down in the 60s and then started to come back, I would consider doubling down and getting a 2% position. And then I actually bought this one back in 2019 twice, and then got a double on it as it came out of this down cycle here and came up. So I've already done well on this one before with a double position. Look at the history, it's kind of similar. You can see the super cycle that we're in right now, that we're probably in. We don't know exactly when it's going to. I think if we didn't have trade problems, it would be better, but like it wouldn't be, the down cycle might not be as horrible. But yeah, I would be looking, people have asked me a little bit about it. So down in the 60s and then starting to come back, and that's when I'd be looking to add. Okay, if you found this useful, hit the subscribe button. And if you have a request, put it down in the comment section. I'll get the ticker on the list. I also have a free tier on Patreon too. I haven't posted too much extra there because I've been busy, but occasionally I'll post some thoughts on book chapters and things that I'm reading about investing. And I'll probably add some more type of content there that's just a little less formal over time, and still kind of feeling that out. But if you don't want to do the $5, just do the free tier. I post all the YouTube videos on that tier too, so you can see them all there. And thanks for watching. I'll see everybody later. Bye.